Hi, everyone. This is Jason Barack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest, and he's actually one of my favorite interviewers of all time. Been listening to him for many, many years. I started learning from him 15, 20 years ago, very, very long time ago. He's the president of Financial Sense Advisors, a longtime money manager, and he's the host of the popular Financial Sense Newshour, I think since the 1990s. Jim Puplava, thank you for joining me again.
Hey, Jason, good to be back with you. Happy holidays.
Thanks, you too. So we're recording this interview on Wednesday, December 6, 2023. The dollar index is rallying a little bit to 104.21. Paper gold prices have been smashed a little bit. I think they're down around $120 in the last couple of days, down to like $2,020. But I want to get your thoughts on the lag effects of the interest rate hike. So 18 plus months now of higher interest rates. What type of damage do you think that they've done to the real economy and to asset markets so far?
Well, I think when you look at what damage they've done, Jason, you got to look at two sides of the economy. You've got the private sector and you have the government sector. And if we look at the private sector, it's hurting. I think the ISM has dropped, 16, 17 months in a row. We've seen retail sales, they're up. But if you adjust those retail sales for inflation, it's probably not going much. And I think we're in a recession. And I think you're starting to see that now with the drop in bond yields. And I think you're seeing that with what companies are saying going forward. So there's been a lot of damage that's done. It's just been a delayed effect. And the reason it's been a delayed effect, in my opinion, for two reasons. Number one, the economy was less susceptible to rate hikes this time around, Jason, because when you think of all the people that have refinanced their homes. In the last decade, when you could get 3% mortgages, what company didn't refinance their debt? What consumer didn't refinance their mortgage? So they were less susceptible to a downturn in interest rates because they locked in those lower rates. The second thing is, and I hope we'll get into this, but government spending increased by almost $11 trillion. So, the stimulus checks, and if you take a look at the budget for 2024, they're talking about another $400 billion in increase in spending. So I think that has shielded some of the effects of this giant hike that we saw with the Fed going from 0 to 5.5 in a little over a year.
Well, I also think the distortions are in different places. So you mentioned residential real estate. I think this cycle, the problems are going to be in commercial real estate and office buildings. I mean, there was an interview from a longtime commercial real estate developer on the Blockworks Macro YouTube channel a couple days ago. And the guy's been in the space for, I think, over 2 decades. And he straight up said the entire industry, the commercial real estate developers, the banks, no one's marking to market any losses. The banks don't want to be stuck with all these office buildings. He said it's a mess, but it's being hidden for now.
It's being hidden for now. And while we're on the subject of real estate, one of the reasons that we've seen the real estate market, at least on the residential side, hold up as much has been supply. And I would give you government policy as the reason for that. Number one, as we just talked about, in the last decade, everybody locked in on those 3% mortgages. So, Jason, if mortgage rates are at 7.5 or 8%, why would I dump my house and get rid of a 3% mortgage and go buy a new one at 8? So there's number one. And I'll give you a real live example of a client that we just went through, lives in California, bought a house for $250,000 25, 30 years ago. The house is now worth about $1.6 million. He was thinking of selling it, moving someplace else. And I had to tell him, look, if you sold it for 1.6, you paid $250,000 for it. And the government gives you $500,000 tax-free on capital gains on a house. So you're going to have $850,000 in capital gains, of which you're going to owe $300,000 in taxes. So why would I trade out of my house and trade a 3% mortgage for an 8? Or why would I want to pay those kind of capital gains, especially if you live in a high tax state like I do in California?
Yeah, I agree. And a lot of people are leaving the state of California, but that's a good point you brought up. Also, I think the Biden administration changed the 1031 tax exchange law, which is what a lot of real estate investors and people who are changing homes used to do. And I don't think you can do that anymore. I think you have to pay taxes every time you change homes.
Yep. It used to be back in the old days. And here's another thing the government hasn't done. And this, once again, gets back to my inflation thesis. In 1994, they did away with the exchange. If you, let's say you sold a house for $1 million, or let's just take this same example I just gave you. You sold the house for $1.6 million, but if my client went out and bought a similar home for $1.6 million, there was no taxes. So what they did is they said, we're going to give you capital gains free, $250 if you're single, $500 if you're married. But Jason, they have an index that since 1994. It's like the taxation of Social Security, 25 and 32. They haven't changed that either.
Well, the government economic data is so flawed. I mean, they're not updating the jobs reports are revised downwards by 50% 1 month, 2 months, 3 months later. The consumer price index, I think they assumed that healthcare insurance costs were down 34% in the last month. So it's just ridiculous.
Yeah, they do something about, they do this thing called hedonics. So let's say I want to buy a Ford 150, the price is up 10%. But then they come in and they say, well, it's got a better stereo system. The transmission works a lot easier. We're going to subtract from that. And by the time they're done, the truck only went up by 2%. So I don't know anybody listening to this podcast or even my own that believes that we're seeing 3.3% inflation.
Shadow Stats has it down to 9, but I think in 2022 it was up to almost 18%. I interviewed John Williams a few months ago. He said it got up to just under 18% at one point in 2022.
Yeah, you're seeing it. Just go to the grocery store. I like fillets, and a little over a year ago I was paying 28. Now I'm paying over 46.
Well, Bloomberg News, I don't know if you saw the piece last week, but Bloomberg News came out with a piece extensively going through all the different input costs, electricity, food, healthcare insurance, all the other input costs for the average person or small business owner. And all the costs were up over 20%, which directly conflicts with the consumer price index. So I'm just curious. I haven't heard a lot of people discuss the discrepancies there, but it was an extensive piece by Bloomberg News. I was surprised they actually released it.
Yeah, I mean, all these numbers, and I think you're going to see more improved inflation numbers coming out because I really think the Fed knows it's going to have to start cutting interest rates. And if we want to get into the deficit spending and deficit financing, the deficits are so big. I want to throw some numbers out for your listeners. In 2020 or 2019, the national debt was 22.7 trillion. As we are speaking, Jason, we're at 33. We're just shy of 33.9. We're going to add 3 trillion in debt. So we've gone from 22 to we will be at 34 trillion by the end of this year. And then if you take a look at what the government's done, so the government has increased spending by a little over 10 trillion. The Fed's balance sheet is more than doubled from 4.2 to 9 trillion as of April last year. It's pulled back with some of the QT. So, everybody's going around like there's a mystery why we have inflation. Even Wall Street was taken back by that. And the reason is fiscal dominance. The government is now spending money and putting those dollars into the economy rather than just the financial markets.
And the government counts government spending as positive for GDP and the jobs report numbers, Jim. I think the fastest growing industry for job creation in the last 12 months, it's government jobs. It's not the private sector.
No, it's been 30 to 40% of those job numbers are government. And here's an interesting thing. The government share of GDP has gone from 21% to over 23%. So we're almost to the point where government spending is now almost 25% of our economy. And we know, Jason, the government doesn't create anything. They don't create any goods. They don't create any services. So that is also impacting. And that's why I think we're in this stagflationary environment.
So what options does the U.S. government have for funding then if the Federal Reserve is supposedly reducing its balance sheet? Who's going to buy all of these treasuries that the U.S. Treasury needs to sell and refinance and roll over at higher rates when you have the normal buyers the last 20 years of U.S. Treasuries like China, Germany, and Japan? They're not net buyers.
That is going to be an issue that, in my opinion, you're going to see the Fed start to monetize. And the reason being is if you look at 2014, foreign central banks stopped buying U.S. Treasuries. And so we changed the laws for the banking system and for money market funds. And up until probably the Fed rate cycle, banks were financing a lot of that government debt. But what happened? The Fed raised interest rates from 0 to 5.5. And Jason, we have the banking system sitting on probably 650 to 700 billion in losses. Let's not even get into the commercial real estate losses. Just on their treasury portfolio, they're sitting on over 600 billion in losses. And of course, the Fed came in when we had those banks go under in March, and they said, well, if you have $1 million bond that's only worth 700,000, why don't you swap it to us? We'll take that bond and give you $1 million back. What's going to happen when that time period runs out next year? And so there's something that we follow. It's called the MOVE Index, and it measures volatility in the treasury market. And Jason, every time it gets up to about 140 or above, there's a mishap in the treasury bond market. And it's no surprise that in October, the MOVE Index got up to 140. What was happening at that time? The dollar was strong. Interest rates were high at 5.5. You had the 2-year, the 10-year, the 30-year bond all over 5%. And all of a sudden, the Fed start changing its story. They're saying, hey, the bond market's done our job for us. They start pulling back. The dollar goes down. And as we're speaking right now, we've got, just looking at my treasury screen, we've got the 10-year note at 4.1%. So we've gone down a full percentage point. And the reason is people are anticipating recession. That's what the bond market's anticipating. But the point I'm making is anytime it gets up to 140, we're having problems in the repo market. We're having problems in funding. There was an auction that was done in October where the bankers had to increase the yield on the, I think it was a 10 or a 30-year bond. They had to increase it by 7 basis points to get any buyers. So in the end, we're running out of buyers. Banks don't want to buy because they're sitting on massive losses in their bond portfolio. They've got losses in commercial real estate. Foreign central banks aren't buying. That's only going to leave one buyer. It's going to be the Fed.
Unless they force people to buy a certain amount in their retirement accounts, kind of like what happened in wartime, where they forced people to buy war bonds.
I could see a day like that where they're coming out and saying, maybe you have a stock market crash. They'll call it the Retirement Security Act, and you're going to be forced to have 20% of your 401k in worthless zero coupon treasuries. But basically, you're going to see the Fed, and then they'll create some kind of legislation that will force pension plans or institutions to own treasuries, because the foreigners aren't buying. As you're seeing China, you're seeing the BRIC countries are moving out. And I think you're going to see the price of gold once again resume its role as a currency. And I think that's one of the reasons we're seeing gold as strong as it is.
Yeah, Ben Bernanke, actually, he was hired, I think, by the Bank of Japan years ago as an advisor, and he was recommending that they start with zero coupon perpetuals, that they roll over the debt into zero coupon perpetual bonds and inflate the debt away. So I wouldn't be surprised then if that's adopted here, because that's what the former central bankers, they seem to be recommending that for Japan, and Japan's further along the road than the US is.
I couldn't agree more. I think that's down the road. And I also believe at some point in this decade, my time frame is probably 27, 28. You're going to see a massive dollar devaluation. And in my opinion, that devaluation is going to be done against gold, because if you devalue your currency against the euro, the yuan, or let's say the Japanese yen, you get into a currency war. We devalue, they devalue. But if you devalue it against gold, and I think that's coming as well.
So I would argue that you probably read more investing books and financial history books than almost anyone out there. Maybe Dr. Mark Faber and a few other hedge fund managers I know. You've read many, many hundreds of investment books. You've interviewed experts like Adam Ferguson and When Money Dies, and you've talked about these over the years. I interviewed Dr. Mark Faber in the last month or so about the history of interest rates and government spending. Do you think that the governments are actually going to allow real deflation for a long period of time? Or do you think that we're too far along here with the amount of debt and the tax receipts would collapse, where the economy and the government cannot handle deflation for a long period of time?
There's no way they could handle deflation, because that brings home the true cost of debt and all that collateral. Just think of all the loans that you have to businesses, to corporations, on mortgages, commercials. I mean, just look at the problem you have right now in commercial real estate. So the only way they can handle debt, there's 3 ways to get rid of it. You pay it off, you default on it, or you inflate it away. And throughout history, the number one course pursued by governments, kings, emperors, prime ministers has always been the inflation of debt. It's a stealth tax. It creeps in. And I mean, take a look at the way they're talking about inflation. It's like some kind of mystery. It's corporations. It's the damn unions wanting more money. It's a company wanting to charge. It's an oil company gouging consumers on gasoline. They'll blame it on somebody else but themselves.
They're also blaming it on us. There was a new op-ed coming out that it's our fault that we're consuming, that there's inflation now. So the stories just keep changing.
Yeah, I mean, they're always going to have an excuse. They'll never point the finger back at their spending. One of the things that really surprises me in this presidential campaign, and I've been pounding the table on this deficit issue and the amount of debt that we're taking on, and especially now with the Fed raising interest rates, and we've got all of these treasuries. Unlike you or consumers who refinanced their mortgages and their debt, and corporations did the same when interest rates were low, the government did just the opposite. They were doing it in 3-month T-bills, 6-month T-bills, because they were paying 10 basis points on a 3-month treasury. I can remember during the COVID year, 2020, there was actually a period of time there was a negative interest rate on treasury bills. So now that debt is coming due. And instead of the 10 basis points, 20 basis, or even 50 basis points on 10-year bonds, now they're rolling them over. They're paying 4 to 5.
So for hyperinflation, I know you've interviewed Adam Ferguson of When Money Dies, and he wrote about the Weimar Republic hyperinflation. He actually predicted that the U.S. will not have hyperinflation and that the U.S. will just have worsening stagflation. Do you agree with him, or do you think that a world reserve currency, that this would be the first modern world reserve currency to potentially have a hyperinflation?
I don't know if we're going to see hyper, but certainly I think we're heading for, as John Williams just reported, where he said, we actually got up to 18, 19%. I think we could easily get in. They won't report it that way, but we could easily get into the 20 and 30% inflation rate.
That would be just killer for the average person there who is living paycheck to paycheck, who can't buy inflation hedges, doesn't own a lot of assets that are inflation hedges, can't grow their income. That would just destroy their standard of living pretty quickly.
Well, you're already seen it in California. We've lost, I think, about 1.5 million people have moved out of the state. The governor won't acknowledge it, but my goodness, we lost a couple of congressional seats because of loss of population leaving the state. We've had over 500 companies leave the state. And you're right. I mean, if you are a middle class or a poor person, you can't go to your boss and say, hey, gasoline prices are up 30, my utilities are up 20-something%, my food costs, I need a 20 to 30% raise. It just doesn't happen.
Well, that's why you see people in the jobs data, they're working 2 or 3 part-time jobs. I mean, there's a lot of shenanigans going on online with OnlyFans and things like that. People are hustling. They're doing whatever they can to earn an extra income, a side income or a side hustle.
Yeah, 2 or 3 jobs. I've got clients. And there's also another thing that you can say too. My generation, the boomers, they are working longer because, number one, the money they save doesn't buy the same standard of living it did 10, 20 years ago. So instead of retiring at age 62, 65, you've got people that are working into their late 60s. I have a couple of clients that are in their 70s still working.
So you think then that the best case scenario for the U.S., the way things are playing out, because of the government spending, D.C. is not going to stop spending, the interest payments on the debt, the pace of national debt is growing. The best case scenario is worse stagflation?
I think it's stagflation, but I think it probably could get a little worse than that, especially when you start getting into 20 and 30. Let's say they really start pushing it. And I see that coming. I see a crisis coming in 25. They're going to do everything they can, Jason, to make things look good for the election. But let's put it this way. Medicare runs out of money in 2028. Social Security runs out of money in 2034. If you are a politician, are you going to go and tell people you're not going to get a check? We're going to reduce your benefits? Probably not. What I see happening is a likely one. It'll have to be a compromise, but we have beginning benefits at age 62. Now, if you're a boomer, full benefits at age 67. I can see them moving beginning benefits to age 65, full benefits at age 69 or age 70. And then also the possibility, depending on your income, and they're already doing this with Medicare, by the way, that most people don't realize. If you are in Medicare and you have, let's say a big year, you took some capital gains or something, your income jumps up. There are 6 tax bracket categories for your Medicare Part B premiums. They can go from 165 to well over 500. So they could start doing something like that, which they've done with Medicare. And I could also see them going to people that are fortunate enough to have a good income stream. They saved, they worked hard, they have a lot of income, where for every dollar over this amount, they start phasing out your Social Security benefits. I see that coming as well.
And I've lived right outside of Washington, D.C. for over 20 years, and I speak with some of the lobbyists and some of the people inside the chief of staff political for some of these campaigns, or the people that they hire to look through bills and stuff like that over the years with my contacts. I could tell you that none of the key decision makers here in D.C., both parties, none of them actually want to cut spending. It's just a tragedy. And then on top of that, Jim, you have now our politicians, they're actually the best hedge fund managers in the United States because they're trading on inside information. And they're getting rich quick or getting richer, making tens of millions of dollars, and no one's going to prison.
Yeah, I mean, it's amazing. I mean, I think there was, were they going to come up with an ETF to follow Paul Pelosi's trades? I mean, he's done better than Ray Dalio. I mean,
she's on all the congressional committees and subcommittees on the tech one and some of the others. So she's getting the inside information and she can trade on it.
Yeah. Well, they say you go to Congress, retire in 15, 20 years, and you're worth about 10, $20 million. I mean, it's a big boys, rich boy club. If you look at a lot of the money these people make.
It's faster than that now. I think AOC is probably worth over $10 million in about 5 years. That's my opinion.
It's not bad for being a congressman for 2 terms or 3, whatever it is.
So it sounds like the government's goal is to then inflate the debt away. So they're paying back what these social transfer payments in nominal terms, and the real value of the debt's being inflated away. Does that mean a bond bear market for years longer, or no?
I think what they're going to do is use financial repression very much in the terms of what, let's say, Japan has done, where I think you would see the higher interest rates would be in the credit markets like the corporate bond market, but they're going to have to come in with financial repression and do yield curve control because the government cannot sustain. I mean, the way I'm reckoning right now, at the present pace that we're trending and the kind of spending bills that they're proposing, the president was on the air today pushing his $110 billion Ukraine bill. And those, by the way, Justin, as you know, are supplemental bills aside from the regular budget. So they're talking about increasing spending next year by another $500 billion. And next year, by my reckoning, by the way we're going to add another $4 to $5 trillion. So let's just make this easy. By the end of 2024, we're going to be at $40 trillion. You can imagine if we were to be paying 4 or 5% interest rate, it would take 40% or more of government tax revenues. And by the way, one of the things I follow, in addition to corporate statistics in terms of how well the economy's doing, the other one I follow, Jason, is tax revenues. And tax revenues are down by $250 billion. It just dropped again. So if the economy is doing as great as people are saying it's doing, then why are government tax revenues dropping?
And that's without the stock market crashing for a couple quarters or home prices crashing. So if asset prices crash, it'll be even worse. It'll compound that tax receipt collapse even further.
Oh, absolutely. They had a real big jump in tax revenues in 2021. What was happening? The Fed came back and was inflating the economy. We were recovering from the lockdowns, and there were huge amounts of stock options, capital gains. My own state of California gets over 20% of its revenues from options and capital gains. The government is almost in the same category. So you get a real bear market, and like we did in 2022, where you had bonds down over 20%, stocks down from 20 to 30, you could see tax revenues drop by 20 and 30%, which would just exacerbate the deficit.
So I want to transition now to oil and energy, because I know you've interviewed a ton of oil experts the last 10, 15 years. You've also read a ton of research reports. on the oil market, peak oil, read a lot of peak oil books. So I probably more than anyone else out there, other than maybe some of the oil hedge fund managers. I want to get your thoughts on the damage that these ESG policies have done. I call it the energy spending grift. Do you think that they've created long-term supply problems for the non-ESG energy plays? So like liquefied natural gas, oil, uranium. Do you think that we have long-term supply problems now because of all the wasted funds and losses, negative return on investment from ESG policies?
Oh, absolutely. It's even worse than that. Let me just move from oil for a sec. Well, no, stay on oil. They're pushing windmills and solar panels. Well, what do windmills and solar panels require? Raw materials. How do you get them? You get them from mining. What do mining companies do? They run these big earth moving machines that run on diesel fuel. So diesel fuel is needed to do mining. And it's not just the ESG that has curbed investment, but they're also shutting down mines. They're closing down parts of Alaska. They've closed down copper mines in Arizona, Minnesota, Maine with lithium. And it's not just here, Jason. They're not satisfied to stop at mining here. They're trying to stop it globally. They're trying to stop a mine production in Panama. So it's not just here, it's around the globe. So they want clean energy, but they just don't want the materials that go into clean energy unless it comes from China.
Well, but these policies make no sense, though. Like you said, you were describing some of the ways, but then you have banks, they have ESG policies that were put in place the last 10 or 15 years. And in pension funds and institutional investors, a lot of them have bylaws in place, and the average person is not aware of this. They cannot invest in non-ESG energy stuff. So even if they want to fund a copper mine and the copper is needed for electric vehicles or silver or some of the other key critical metals, I think the Department of Energy just put copper in the critical metals list because it's going to be needed for electrification and electric vehicles and improving the grid. They're not making the investments into new supply.
And I think, Jason, the one thing I'm a little bit more hopeful is I think that's starting to change. I know a lot of the states' attorney generals went after companies like BlackRock and others and Vanguard for their ESG policies and stopping funding of critical materials. So I noticed that BlackRock is backing away from some of their ESG stuff, and even Vanguard is doing that. So I'm a little bit more hopeful in that area.
But won't this still create years? Then there's going to be years before new supply is brought online, because where's the oil production growth going to come from? I mean, I guess the Saudis can maybe increase oil production capacity a little bit. Do you think, though, that there's any type of oil production growth that's going to come from the Permian Basin, or do you think that's going to be sputtering out now?
I think I'm in the Rosenzweig camp, the Goring and Rosenzweig camp, that the Permian is going to peak out, just like the Eagle Ford and some of the other shale plays like the Bakken. I think that's going to happen in the next year, or certainly by 2025. So right now, one of the things that have kept prices a little bit low is production in the U.S. has been over 13 million barrels a day. But I think we're watching the productivity in the Permian decline, and it is following the same pattern that we saw in the Bakken and the Eagle Ford and some of the other Permian or shale plays that we have. So I think we had a short-term window of a little over a decade. Instead of using that wisely, for example, instead of pushing EVs, we should have been pushing, hybrids. I think we're headed for a decade of energy and resource scarcity. I don't care if it's going to be copper, if it's going to be silver. Heavens, you take a look at the major silver mine in the world, which is Mexico. I think I read a report that their mines peak by the end of this decade. China, same thing. So I think we're headed for a decade of scarcity and higher materials, which once again is going to be an inflationary impact.
The production for copper and silver as a byproduct with the base metal mines for Peru, Chile, Mexico, so the largest copper miners in the world, it's all been trending down for the last 3 to 5 years. So they've been not even permitting a lot of these potential new mines, or talking about shutting them down or delaying production growth. And then on top of that, that's assuming that metals prices stay high. So if metals prices go low, then there's really not going to be a lot of investment into that. And then you add in ESG policies or higher royalty taxes if metals prices go up. It's not a lot of incentive for the miners to bring new mines online.
No, and once again, I think we're headed for raw materials and an energy crisis. The energy crisis, I think, what was it, 1992, we had 112 nuclear power plants. We're down to 92. China's got over 50 and they're building 24. India's got like 28 and I think they're building 14. So China and India are building nuclear plants, they're building coal-fired plants, and what we're doing is we're shutting down nuclear plants and natural gas. Now, it's not just enough that they want to go after oil, but they also want to go after natural gas. They want to get rid of natural gas stovetops. They want to get rid of natural gas heaters. They want to get rid of natural gas heating of your home. So and one of the reasons that the US has had better, lower emissions has been the switch from coal to natural gas. So they're not just going after one thing, they're going after clean fuels like nuclear and natural gas, and they want to replace it with intermittent and less efficient forms of energy like solar and wind.
Well, I think things in the last couple months for nuclear power may be changing. So I think there was a conference in the last week or so, and I think they were talking about starting to rebuild nuclear power plants. But for the Western countries, the US and Europe, Canada, it's going to take many years of permitting. So that this should have been done 10, 15, 20 years ago. And instead, the funds under Obama and even George W. Bush, who was with corn ethanol subsidies, those funds should have been directed instead of solar, wind, and biofuels. It should have been directed at nuclear power for cheaper electricity.
Well, absolutely. It takes us 10 to 15 years to build a nuclear power plant. China can do it in 3 or 4.
So for oil production growth, then, it looks like the Permian I guess the estimates vary on when, but where's the oil production growth going to come from then to replace the supply that's being depleted?
Well, I think it's going to have to come with higher prices. There's only one way that's going to stimulate a company like an Exxon, a Chevron, a BP, a Shell, or hell, a ConocoPhillips. It has to be higher prices, because if oil companies, and this applies, Jason, also with miners, if they feel the price is spiked up, but it's not going to stay there, why are you going to invest $5-10 billion drilling for oil or trying to find a new mine when you're not assured that the price is going to stay there? And that's why I think you see a lot of these companies are either buying back stock, or if they're doing any drilling, it's drilling on Wall Street. Hence, take a look what Chevron has done this year and what Exxon has done. And rumors are a couple of the other big ones like ConocoPhillips and some of the others may be doing the same thing.
Yeah, I think Chesapeake is looking at acquisition, buying some old assets as Southwestern for natural gas. But that's a good point. So in 2021 and 2022, when the commodity prices were high and in a cyclical bull market, there was not a lot of new supply that came online. I think there was some natural gas in the Permian that came online, but that's been coming offline the last 6 to 9 months.
Well, take a look at the 2020 election. What did Biden say? He said, I'm coming after fossil fuels. We're going to get rid of them. So if you're an oil company and Biden just got elected, what are you thinking, even though the price has gone up? I certainly wouldn't be making some big investments when the president of the United States is at war with your industry. Why would you?
I want to transition to gold now. So the gold price has been in a trading range the last 2.5 years in the US dollar gold price. In other currencies, it's in a bull market. In Japanese yen, Australian dollar, Chinese yuan, it's at or near all-time highs. Do you expect a new gold bull market in US dollar gold price to restart soon?
I really do. And I think the probably is going to be, I think you're seeing it right now. I am really surprised. I know they tried to knock it down. I mean, it was obvious what they were trying to do Sunday night. But the fact that gold has held up this strong, and I think one of the reasons, it's the largest buying by central banks in almost half a century. And I think that's one reason that you've seen gold stay a lot stronger than silver. But also you have, it's do or die for many of these EM countries because, for example, you take a look at what China is doing with the emerging market countries. China does not want to open up its domestic market, bond market like the US. So if you have excess dollars that you're trading with the US, you can recycle those dollars into our treasury market, which was what they were doing up until 2014. What China is basically doing, and they're the largest single buyer of gold around, they're basically saying, look, we'll trade in yuan. I'll buy oil from you. I'll give you yuan. If you have excess yuan that you don't want to invest with China, we can settle on the Shanghai exchange and exchange it for gold. And that's why I think that this is kind of moving away from the manipulators. And I think gold is going to resume its historical role as a currency. So I expect higher prices for gold. And I think you're going to see that in 2024, especially if we hit a recession in the first quarter, which I'm expecting. And also you see some turbulence in the stock market.
We have very weird market conditions now because on a relative basis, the gold prices are still relatively high. We're around $2,000 an ounce. So for the first month in history for the US dollar gold price, we closed above $2,000 an ounce. But yet on the supply side, the mining shares, they're pricing it, their valuations are as if gold price is around 1,500. The junior miners or companies who have a pretty good project and are looking for financing to go build a mine, there's little to zero capital available. And it's dire bear market conditions.
Yeah, it's absolutely. And that's why Barron's last weekend did an article, Don't Buy Gold, Buy the Miners. And they were pointing out this very same thing. I mean, you have $2,000 gold at this level. These mining companies are making a lot of money on $2,000 gold. And you can see it in some of these companies talking about issuing special dividends again. And that's one thing I think that's much different in this decade than, let's say, the '00 decade, which was the last big run-up that we saw in gold. I mean, companies were buying other companies for $1,000 gold in the ground. Some of the acquisitions, the way they ran these companies, things are a lot more tighter today with a lot of these companies. And Jason, for the first time, at least in my career, in almost 2 decades, you're getting some halfway decent yields on mining companies.
Yeah, the valuations are super cheap. A lot of the producers with pretty good profit margins and the earnings are going to be good the next couple quarters. They're trading at below 3 times cash flow. So the market just doesn't believe this gold price is sustainable. Or I guess people just want physical gold or some type of gold ETF exposure. They don't want mining exposure. Even Franco-Nevada is cheap now.
Yeah, absolutely. I mean, you take a look at Newmont. Newmont has a 4% dividend yield. Barrick has 2.3. Agnico Eagle 3%. Goldfields almost 3%. I haven't seen yields like that. So the thing I like about it, while you're sitting and waiting for the stock to go up, you're getting paid for it. You're almost equivalent to what you could get in a 10-year treasury bond right now. So I think the place to be, at least from my perspective, I would be buying the miners. I agree with Barron's 100%.
Yeah, I think there's contrarian value for a lot of non-ESG energy plays, a lot of Canadian US oil producers, a lot of gold companies. There's contrarian value there with the cash flow multiples. They are cheap. But it seems, Jim, that a lot of people right now, they're going into regular gold exposure, Bitcoin, they're going into short-term US treasuries and money market funds. This seems to be, although recently in the last week or so, there's been more people buying the long bond, I guess, trying to bet on the rate cuts. But it seems a lot of people were going into risk off, kind of trying to play defense.
There's a bit of that. And I think, especially with the younger crowd, they're looking at, cryptocurrencies. But, I'm just looking at the GDX. And if you're a technician, this is a perfect textbook reverse head and shoulders pattern. And we've just seen a breakout above that. So I'm a lot more optimistic on the miners. I think they've been undervalued. And I think they're great bargains there. Like I said, you can buy them for low multiples to cash flow, low PE multiples, high dividends. And one thing I think the miners did this time, and this is just isn't the precious metals. You've seen it in the base metals, and actually you've seen it in the oil patch, where they have a base dividend and they've been raising that. But then when the price goes up, if it stays up for a while, cash flow increases, they issue special dividends. And I think you're going to see more of that going forward.
Or they start buying back shares because that's tax efficient too here in the United States, because then you're not triple taxed as a shareholder because corporations are paying all these taxes on dividends and the shareholders are paying taxes on dividends. If your stock is that cheap, I mean, the management should be looking at valuation and starting to buy back some stock.
Oh, absolutely. That's just a good allocation of capital. And we've seen that in a lot of these companies. And we're seeing it also, once again, in the oil industry. They're saying, why should we invest? We'll just buy our stock. If the stock is cheap, we'll buy it. And you've got that. They're increasing dividends. Chevron, which just made this acquisition of Hess Corporation, they're saying next year they're going to increase their dividend by 8%, and they're going to continue to buy stocks. And same thing going on with Exxon.
And then they have all that exposure to deepwater offshore Guyana, which is the major growth play right now.
Yeah, that's one area we're very much interested in. And I think that's one of the big plays. There's still a couple plays when you asked earlier, where's the next increase in oil going to come from? There are some pretty big plays out there that they're looking at developing. I know Exxon's in that area. I think Chevron is in that area. A lot of the big boys are looking at that. Although, once again, geopolitical risk, we have Venezuela that wants those oil fields.
Well, I wouldn't be surprised since ExxonMobil and Chevron have a lot of investments there if the U.S. starts sending aircraft carriers there to protect their interests.
Oh, I definitely, you would see something like that because we may not want them producing oil in this country, but if they can produce oil someplace else, we're okay with that.
Yeah, depending upon who wins the next presidential election and how things turn out in Congress, because a lot of the Democrats are pretty anti-oil with the policy. I know they're claiming they're going to refill the Strategic Petroleum Reserve, but call me hesitant about if they actually do substantially.
No, not. And, the time to do it is when the price is low. When the price is low, they didn't do it. So the fact that they haven't done it now, and there's a special provision that I think they sell like 20 million barrels a year or something. There's some kind of budget resolution where they're able to go in and sell more oil from the Strategic Petroleum Reserve. But we're down, Jason, down to 1983 levels. So imagine if there was a serious war to break out in the Middle East that would disrupt oil supplies for tankers in the Gulf. We'd be in serious trouble.
Wait, isn't it down already 50% from the highs in November 2022?
Oh, absolutely. I mean, and it's not just us. Remember, it was also the reserves. The Europeans were doing the same thing. They were releasing oil from their stockpiles to keep the price down. So governments, because Europe is just as ESG, if not more than the US is. So the same problems that we have here and are going to have, they have over there, but they're worse.
As we wrap up here, I want to ask you a big picture question about all these governments, global macro and finances. It seems with the interest rates staying at these levels, especially with the dollar where it is, a lot of foreign banks are going to have a lot of problems. I know European banks were going into money market funds a couple weeks ago and borrowing a lot of US dollars. I heard that directly from a banker I interviewed a couple weeks ago. Do you expect, if interest rates stay at these levels, do you expect a lot more currency debasement and a banking system crisis maybe starting outside the United States in the next couple quarters?
You could very well see that. I just read a report that the Europeans are actually thinking of lowering interest rates. They're going to have to, or otherwise they're going to be running into the crisis that your banker talked about.
It just seems like a mess. I mean, all these governments and central banks, they're all kind of doing the same stupid policies. The last 3 years, they increased the currency supply by many, many trillions. Now they're claiming that that there is no more inflation. I've seen people on TV, the talking heads, saying that the Fed has fought inflation. Inflation is dead. It's just kind of ridiculous.
Well, you know what I see? I see they're trying to drive the dollar down. This might be a short term, take some of the pressure of foreign central banks selling treasuries. But all I think, Jason, this is going to buy them maybe 3 to 6 months worth of time. And then I think the real issues, the more debt that we keep adding, the more debt that keeps rolling over at higher interest rates, the more pressure it's going to put on the deficit and financing. And there simply won't be enough money or buyers out there to finance it. Right now, the thing that I'm really concerned about, you don't hear too much about it, but a lot of the financing of our treasuries right now are being done by hedge funds. They're buying bonds in the short-term market and selling them simultaneously in the futures market, making the difference on the spread. And the only way they're making money is leveraging the hell. 100 to 1, I've heard figures even larger than that. And that's just a recipe like long-term capital management, where some rogue wave or some black swan that you and I can see right now. I mean, how many people saw Ukraine? How many people saw Hamas? Some kind of event that happens that throws these markets off kilter, and all of a sudden somebody blows up.
Well, that's the basis trade that you're describing, right?
Yep.
Well, the hedge funds, the large hedge funds and the portfolio managers, the bond portfolio managers at the investment banks, they got in trouble with those over-leveraged bond trades, doing the basis trade, doing risk parity back in 2019 during the repo crisis. And they had to change a bunch of rules. The Fed created another shadow liquidity and bailout program with the permanent repo facility. If you remember, the rules were changed a bunch of times in 2019, similar to the BTFP that was Silicon Valley So, and then they were loaning at par. So it sounds like the similar types of games and a new Fed shadow liquidity program.
Yeah, it's just amazing. You would think that we would learn from history, but we're doomed to repeat it.
Well, I think it's corruption and greed. I was listening to an interview with billionaire Ken Griffin from Citadel, and he was just railing on the regulators, talking about how the basis trade shouldn't be banned. But I'm pretty sure, and I've heard this from a bunch of people, that all the big risk parity players, like Ken Griffin at Citadel and Ray Dalio Bridgewater, those guys blew up in 2019, and the Fed's balance sheet expanded officially by $1 trillion in like 2 or 3 months. Those guys got bailouts on their leveraged bond trades.
Oh, absolutely. And, if you know that you can take risk and if you make money on the risk, well, you're happy as hell. But if it blows up, you're going to get a bailout. Well, James, I'd be trading all day long if I knew that, I'm backstopped by the federal government if I lose. Who wouldn't?
It's a rigged casino then. Sounds like profits are privatized and losses are socialized.
Yep, exactly.
And this goes back to deflation. Then I know you've read a bunch of books on deflation. Look, the free market produces beneficial deflation. I think it's the governments and the central banks and the leverage in the banking system with debt-based fiat currencies and fractional reserve banking and the derivatives. They can't really, at this point, the amount of debt now since 2008, they can't really allow deflation for a long period of time.
No, it's simply the whole system would collapse if they did. I mean, as we started this conversation, we were talking about losses in the commercial banking center. Just throw those commercial losses on commercial property on top of the losses in the treasury bond portfolio, and our banking system would be insolvent. So they can't do that. Although one of the people that we interview is ITR Economics. They're predicting a depression. I think it's 2030, a deflationary depression. And there's a whole bunch of things we could get into, but I think it's going to be inflation for the balance of this decade, at least from my perspective.
I'm not sure how we can have a deflationary depression when there's all those supply side problems with the commodities, because it looks like there's not investment being made. So maybe there's just so many distortions that there's in consumer price inflation on commodities and food and stagflation and shrinkflation there on the supply side for commodities and consumer discretionary items. The consumer just doesn't have discretionary income to pay for that stuff.
Yeah, one of the things I've learned in the last couple of years is everything you learned, just throw it out the window, because this is not a normal market. It's not acting in a normal way. You would have thought if the Fed raised interest rates from 0 to 5.5%, we would be in a steep financial recession right now, or a financial crisis. None of that has happened as of this point yet. So a lot of these things were thrown out. And this is one of the things that we did this year when everybody was saying go into long-term bonds, we were going into recession. We said, no way. We're seeing a strengthening dollar that's going to be forcing central banks to sell off their treasuries. And sure enough, if you went into bonds like TLT at the beginning of the year, it worked well for you for 4 months, but then you lost over 20%. So it's a different market and it's different rules right now. A lot of this stuff is just thrown off kilter because of all this manipulation, whether it's the Fed, the government, regulation, whatever it is, throw it all into a pot and things aren't playing out according to rules.
The best way to summarize is the distortions. It's with all these crazy policies, and they conflict with each other a lot from governments and central banks. So the policies are conflicting and the markets are not behaving the way people would have bought in the past. So the people, like you said, would have went into the long bond, like Warren Buffett used to do this, buying 30 years treasuries. And instead he bought, I think, 29 billion of short-term US treasuries for Berkshire Hathaway.
Yeah. And because these rules are not working. And there's so much distortion by what the government's doing, what the Fed is doing. And as you mentioned, what they're doing with regulations. And not only that, I can't think, and I draw a lot of parallels to the late 60s and the late 70s. I mean, if you just take a look at who would have predicted the Ukraine war, who would have predicted what happened on October 7th, and who would have predicted COVID or the lockdowns of the economy. This is the first time in my career that a government would actually shut down an entire economy to fight off a virus.
Well, but then they printed what they handed out stimmy checks and they bailed out a lot of large corporations and big pharma and the loans to small businesses, and there was tons of fraud there. So that was trillions, many trillions of new currency units. I think the US alone was over 4 trillion, but there was other governments that also printed trillions. So that was a lot of new currency supply chasing fewer goods and services. So there was tons of people that said there wouldn't be any inflation, but irrationally, there's trillions of new currency units chasing fewer goods and services. So it was stagflation.
Yeah, I think one of the big differences that has surprised a lot of people when the Fed printed a bunch of money coming out of the financial crisis of 2007 and 2009, a lot of that money either went into the financial markets or it stayed on the balance sheet of the Fed. I think the difference this time is government is actually taking checks and giving individuals, companies checks, as you just mentioned, but also putting those checks and spending that money into the economy at the same time they're reducing supply. And, the classic definition of inflation is too much money chasing too few goods. And that's certainly what we have today.
Yeah, it's just such a mess. And unfortunately, the majority of the problems are from DC, and it's both parties, and neither party is serious at all about spending. What it isn't the debt ceiling, the newest debt ceiling agreement is uncapped through the next election.
Yeah, the really thing that really surprised me, especially on the Republican sides, the Republicans are just as bad as the Democrats. You don't hear, have you heard anybody running for office talking about reducing the deficit or reducing spending? Nobody's talking about that. They're talking about, I'm going to do this. I'm going to cut taxes here. We're going to do this. We're going to rebuild the military. We're going to spend money here. We're going to add this entitlement. I mean, it's both parties in Washington, I think, has bought into this modern monetary theory. When you can issue debt in your own currency, there's no limit to what you can spend.
Well, they're going to have to walk back the MMT, because MMT people back in 2020 and 2021 were claiming the stimmy checks printing that there wouldn't be any inflation. So clearly they were wrong about that.
They've been wrong on so many things, but ever ask a politician to admit to a mistake? Unlikely.
Well, especially if they can make millions of dollars and get out of office before the ish hits the fan.
Yeah, not a bad job. Maybe, Jason, you and I ought to run for Congress.
I don't think I'd get elected.
Me either.
Well, I really enjoyed our discussion today. We should definitely have you back on in the next couple quarters for an update. It just sounds like a train wreck, and a lot of it's coming out of DC. It's basic math at this point, Jim, with the interest payments on the debt and the size of the debt, and government spending is heading towards 40 or 50% of GDP, depending upon how you measure it.
Yeah, I mean, once again, this is a point that we've been making at this point too. It's just simply math, and I have yet to have any kind of guess that has refuted the stuff that I throw out in terms of how big the deficits are growing, how big the national debt is, what's happening with interest rates, what's happening with tax revenues, and try to explain to me how this works out. That isn't going to be inflationary, and nobody seems to be able to counteract that.
Well, people are blaming capitalism, but central bank policy and government spending like this is not capitalism. I mean, this is waste, fraud, corruption, and abuse at just historical levels.
No, it's crony capitalism, if anything.
Well, I would say it's the merger of state and corporate interests, and the insiders in DC and the DC metro area, along with their corporate backers and lobbyists and special interests, they're stealing as much as they can before the system collapses or a new system.
What's the old saying? Eat, drink, and be merry, because tomorrow we die. And that seems to be the philosophy in Washington.
Well, I call it the District of Criminals for a reason. So thank you very much for your time, and let's definitely do this again.
Absolutely. Thanks for having me back. And once again, happy holidays to you and all your listeners.